Welcome to Cannon Chambers. I'm Patrick Cannon, and in this video I'm going to be talking about capital gains tax and flipping high-end cars. So I thought it would be helpful to offer some thoughts on the UK tax treatment of selling on high-end, difficult to get hold of new cars at a profit. This has been a thing since the pandemic, when supplies of rare cars were even more restricted than usual. This has led to the lucky few buyers who are on good terms with a car dealer who has an allocation of a few of these scarce cars from the manufacturer, being able to buy on sale or return terms, and who, having bought the car, immediately put the car on sale with the dealer at what in some cases have been a huge markup. And this simply reflects buyer demand and restricted supply. It's pure capitalism at work. Now, examples of these types of car, which were going for huge overs, are the Porsche 911 GT3s and 4s, turbos, 992 Sport Classics, the rarer Ferraris, including the Purosangues, and in the recent past, the new model Range Rovers and Defenders, although these last two are now virtually unsellable due to the epidemic of theft caused by how easy it is for thieves to bypass the car's security, start the car and drive it away, leading to these vehicles being difficult, or in some cases impossible, to insure, especially in London and other big cities. Now, to see the current state of the market for these types of rare car, all you need to do is go on the Auto Trader website, and I would recommend downloading the AT Price Tracker extension for Chrome, which is free, and it shows you the price history of every particular car advertised. Right now in the UK market, the asking prices of many of the high-end cars are being reduced, especially some of the Porsches, although certain models, such as the 992 Sport Classic, remain in very limited supply and are going for huge overs if you can find one for sale that hasn't been exported to other right-hand drive countries or put in an air-conditioned garage in places like Switzerland by wealthy UK expats. Now, a word of warning from a tax viewpoint. There is some confusion and misunderstanding among buyers, sellers, and investors in these types of cars about the correct UK tax treatment, especially with many believing that they can routinely flip cars at a profit tax-free. This may be true in some cases, but is not true in every case. And if you are assuming that the profit on your high-end car is tax-free and haven't included it in your tax return, you could be in for an unpleasant surprise in the 12 months following the submission of your return. If you receive a brown envelope from His Majesty's Revenue and Customs opening a cheque as to why the cars you've been flipping have not been reported to them, you are in for quite an ordeal. HMRC have some pretty sophisticated information gathering resources now, and they're likely to be aware of sales of high-end cars, the list and the actual selling price, and the identities of the sellers and buyers. So let's talk about the basic tax treatment of cars and other movable assets from a capital gains point of view. First, a reminder that when an asset is sold at a gain over the cost price, capital gains tax is normally payable if the gain exceeds the person's annual exemption, which from April 2024 is £3,000. And if you're a higher or additional rate income taxpayer, i.e. earning over £50,270, then the rate of CGT is 20%, except for residential property, where the rate is 28%. Now, in the case of what are called wasting chattels, that is to say, tangible, movable property that is treated as not lasting for more than 50 years, the gains on such assets are exempt from tax, but any losses are not allowable against other taxable gains. Mechanical items, such as watches, are regarded by HMRC as having a useful life of 50 years or less, and as such are wasting assets. And this means that any gains on watches are exempt from CGT. Passenger cars are specifically regarded as not being chargeable assets, and so are outside the scope of CGT. Now, this apparent generosity by HMRC towards owners of expensive cars and watches simply reflects the fact that most cars and watches are eventually sold at a loss over cost price, and so avoids the tax system being awash with allowable tax losses. However, the exemption for gains on such assets does create an opportunity for the savvy investor and collector to acquire cars that will appreciate in value in the knowledge that the gains on selling them will not attract capital gains tax. And this means that a collection of classic or high-end rare modern cars or watches, which the owner has chosen wisely and are gaining value, will be tax exempt compared with, say, a collection of paintings, jewellery, antique furniture, or a wine collection where the type of wine would be capable of being kept in excess of 50 years and remain drinkable. These are treated as non-wasting assets and as such will be taxable on any future gains made on a sale or other disposal where the sale proceeds of individual items or linked sales exceed £6,000. This difference in the tax treatment represents a huge advantage for owners of cars and watches that has no doubt helped to drive the enormous increase in selling prices of such items in recent years. Now, despite this exemption from capital gains tax for cars, there are two main situations where you should, however, pay tax on the gains. And these two situations are what I want to focus on in this video, because it's very important if you are caught by these two situations that you do correctly report the sale to HMRC and pay the tax on the profit. First, you cannot rely on the CGT exemption where the car has been used in a business and capital allowances have or could have been claimed on it. And here the disposal of the car may then give rise to a tax charge as if it wasn't a wasting asset. Second, if your buying and selling of cars amounts to a trade in itself, so that HMRC regard you as dealing in cars, then the cars will be regarded as trading stock and your profit after any allowable expenses must be reported to them and income tax paid. And this is a separate tax from capital gains tax, and you fall within income tax if you're trading. Now, this second category is where flippers of high-end, rare motor cars can come badly unstuck and end up with an HMRC investigation if they do not recognize the reality that they have been operating an income taxable trade of dealing in cars. The fact that the flipper has a cozy relationship with a car dealer who regularly feeds them high-end, difficult to obtain models of cars out of the dealer's limited allocation of that model from the manufacturer, and who then places the cars on sale or return with the dealer, who may share in the uplift in the selling price obtained. This doesn't mean that the flipper is merely an investor or car collector making capital gains on wasting assets that are exempt from CGT. In this situation, HMRC are likely to regard the flipper as a trader liable to income tax. So, what amounts to a taxable trade in flipping cars? Well, for this we have to turn to the statutory definition of trade, and it's in the Income Tax Act 2007 at section 989. Now, this definition makes it clear that trade also includes an adventure in the nature of trade. And this means that activities in ordinary language, which may not be a full-blown trade, can nevertheless be within the tax charge. Now, the courts have looked at this a number of times in the past, and I'll give you two examples where they've held that activities were within the phrase adventure in the nature of trade. In the case of Fraser, there was an isolated transaction by a woodcutter who'd bought a consignment of whiskey and bond and then sold it on through an agent at a profit. And the court held that that was an adventure in the nature of trade. And then there's the case of Chamberlain, where someone who was not a bullion dealer had bought a consignment of silver bullion and then sold it on, and was financed in doing so by a loan at a high rate of interest in circumstances where it was clear that the asset was going to be sold in order to repay the loan and keep the profit. So the likelihood is that regular flipping of cars will be treated as a trade. And for this purpose, I think that 2 or more flips a year will be sufficient to establish a taxable trade, especially where the gains are substantial. Then there's the possibility that an isolated flip of a valuable, hard to obtain car, especially at a substantial profit, will be regarded as an adventure in the nature of trade, as will a speculative flip that yields a substantial profit and relies on short-term financing that is repaid from the proceeds of the flip. And a good example of that at the moment would be acquiring a Ferrari Purasangue from a dealer on car finance, on the understanding that the finance will be repaid within the year from the anticipated sale of the car at a huge markup. So in conclusion, these examples show that it is not safe simply to assume that because it's a car, then the sale at a profit of the car will be exempt from tax. You need to be very careful and take a realistic view of all the surrounding facts if you decide not to pay the tax and don't want to receive that dreaded brown envelope from HMRC informing you that you are now under tax investigation. Do feel free to contact me for further advice if you are concerned to get your tax right, or indeed if you find yourself under investigation, using the link below. Thanks for watching and enjoy your car or cars. Goodbye.